All right, let's dive into this explainer. Today, we're demystifying price action trading, and I'm going to show you why stripping your charts totally bare might actually be your biggest trading advantage yet. Look, if you've ever felt completely overwhelmed by screens that just look like a tangled mess of colorful lines and flashing signals, you are in exactly the right place. We're getting back to basics, back to the raw data, and back to what actually drives the markets. So, here's our roadmap for today. We're going to cover 1. The power of price action. 2. The advantages and disadvantages. 3. Understanding support and resistance. 4. How to actually plot those levels. And finally, number 5, the principle of polarity. Let's get into it. Section 1, the power of price action. What's really fascinating here is that this isn't some trendy new internet fad. This methodology was actually championed by the legendary Jesse Livermore way back in the 20th century. The core belief here is simple, but it's absolutely profound. Price never lies. A price action trader doesn't sit around agonizing over why something is happening in the news. They focus literally 100% on what has happened and what is happening right now on the chart. By ditching all those complex, lagging mathematical indicators, you're just left with pure price movement. And that is driven entirely by supply and demand. This contrast perfectly highlights the massive hurdle for most beginners. Take a look at the top chart, the Nifty 50 Daily Index. Notice how it's completely naked, elegant, and you can just clearly see the natural ebb and flow of the market. Now, look at the bottom chart. It's the exact same time period, but it's totally loaded up with lagging momentum indicators, Bollinger Bands, ADX, RSI, the whole shebang. For someone new trying to find a clean entry point, that visual noise is just overwhelming. And this stark contrast between absolute clarity and total clutter brings us to a really grounding Gujarati stock market saying, Bhav Bhagwan Che, which translates to price is supreme. Honestly, all those fancy indicators from before, they're literally just derived from the price itself. So if you learn to read the price, you are going straight to the source of truth. Moving on to section 2, advantages and disadvantages. So here's the reality check. While price action absolutely gives you a massive real-time edge because the current price doesn't lag like indicators do, it is not a magic bullet. Sure, it's way simpler to understand and it gives you incredibly clear entry and exit levels. But on the flip side, it is going to brutally test your patience. Since you aren't getting constant pings and alerts from a dozen different indicators, you're going to see fewer trading opportunities. It's a waiting game. Plus, you will definitely get false signals sometimes or find contradictory trends if you zoom out to different timeframes. You just have to learn to live with being wrong occasionally. As the legendary American investor Howard Marks so wisely put it, there's no magic formula for being on top. You really have to decide which system suits your own personal trading psychology and just realistically embrace its flaws. Don't go into this expecting to become a billionaire overnight, right? Approach it as a time-tested strategy that demands serious discipline. All right, section 3, understanding support and resistance. Okay, think of support like a solid floor where demand, meaning the buyers, steps in to stop prices from falling any further. When the price drops down to this floor, buyers see it as cheap, so they rush in and overpower the sellers. Resistance, on the other hand, is your ceiling. This is exactly where supply, the sellers, overwhelms the buyers, which stops prices from rising any higher. It's basically a continuous psychological tug-of-war between the bulls charging ahead and the bears pushing back, and it plays out right in front of your eyes. Which brings us to section 4, how to plot levels. Now, following these 4 straightforward steps is basically your key to mapping out those psychological barriers accurately. First, pull up your historical data. You really want to use a candlestick chart here because line charts totally hide those vital intraday price swings. Second, scan for extreme highs or extreme lows. Third, you want to identify at least 3 separate occasions where the price touched this level and then reversed. And finally, step 4, just draw a line connecting those touch points. Looking at this historical monthly chart for Enox Leisure, we can perfectly apply those exact steps. We've got multiple distinct instances spread out over several years where the price dropped right to around the 184 rupee mark and then bounced right back up. By connecting these extreme low touch points, we easily identify a single, crystal clear horizontal support level. This line acts as a highly reliable, repetitive buying reference point for your future trades. But let's be real, sometimes the market just isn't geometrically perfect. As this LG Equipment's chart proves, price action isn't always an exact science. In this case, the price drops, gets kind of stuck, and reverses within a messy downward area, roughly between the 58 and 62 levels, rather than stopping on a dime at one specific price. In these super common scenarios, we just adjust. We plot a thicker rectangular support zone rather than a single thin line. That gives your analysis the breathing room it needs to account for normal market volatility. Finally, Section 5, the principle of polarity. Now, this right here is a massive aha moment for a lot of traders. It's known as the principle of polarity. Basically, it states that once a significant price level is decisively broken, its established role reverses entirely, meaning yesterday's solid floor abruptly becomes tomorrow's hard ceiling. And conversely, a broken resistance ceiling will very often act as a brand new support floor. It is just a fascinating display of market psychology in real time. This simple line diagram perfectly captures the whole concept. Just follow the sequence with me for a second. At points 1 and 2, the price bounces off the support line beautifully. The floor is holding. But then look at point 3. The sellers finally overwhelm the buyers, and the price just crashes straight through that support floor. Now, when the price tries to recover and climb back up, that exact same horizontal line acts as a rigid ceiling, flat out rejecting the price at points 4 and 5. The polarity has completely flipped. So let's look at how this theory actually plays out in reality. Check out this Sun TV daily chart and focus on the shaded rectangular zone between 510 and 545. For a really long time, that was a firm support zone, holding the price up. But then, in June 2019, it broke decisively downward. Months later, in November 2019, January 2020, and February 2020, the price rallied, trying so hard to climb back up. But on all 3 of those separate occasions, it hit that exact same former support zone and got sharply rejected. The floor had undeniably become the ceiling. So we've covered the power of pure price action, the harsh realities of the system, and exactly how to master the psychology of support, resistance, and polarity. As you look at your own trading setups today, I really want to leave you with this thought. Ask yourself if all that visual clutter is genuinely giving you an edge, or is returning to the elegant, undeniable basics of pure supply and demand the actual breakthrough you've been searching for. The price is speaking right now on your charts. The only question is, are you listening?